Welcome to The Deep Dive, the show that cuts through the earnings call noise and gets right to what you need to know.
Great to be here.
Today, we're digging into Forian's Q2 2025 results. And look, this isn't just a numbers review.
No, not really.
It's really about charting their strategic shift, moving deeper into healthcare data, specifically real-world evidence, or RWE.
Exactly. And what we saw this quarter was pretty strong execution on that front. The Kyber acquisition seems to be paying off, at least initially.
Right. A big top-line beat definitely validates the strategy on paper.
But, and this is the key thing, the market reaction was pretty quiet. Little bump, sure, but on super low volume.
Like a prove-it moment.
Totally. It feels like the market's saying, okay, nice quarter, but show us you can keep this going, especially in the second half.
Okay, let's lay out the baseline then. Operationally, it was a big turnaround. Let's start with revenue.
Hit me with it.
$7.5 million. That's up a huge 56% year over year.
Wow, 56%.
Yeah, and it beat the consensus estimate. That was $7.17 million by about 4%. You usually see a bigger pop from a beat like that.
You really do. And that revenue flow, it obviously helped the bottom line significantly. They actually made money.
Flip positive for?
Yeah. Net income came in at $0.224 million. That gives you a GAAP EPS of a penny, $0.01, which that was right on target with expectations.
Still, going from losing money to making it even a little, that's a big psychological win, especially with an integration happening.
Absolutely. And it wasn't just scraping by either. Look at the efficiency gain.
The margins, yeah. Huge improvement there. Adjusted EBITDA hit, what, $0.591 million?
Yeah, almost $600K. Compare that to only $78,000 a year ago. Massive jump.
And operating income, too, that flipped positive as well, around $50,000 this quarter versus, get this, a $3 million loss same time last year.
That kind of leverage points to, well, good cost control after buying Kyber. They're making the acquisition work operationally.
But back to that market reaction.
Right. Despite those three solid beats, revenue, net income flip, margin explosion, the stock only nudged up 1.6% the next day. Tiny volume.
So investors are seeing it. They're acknowledging it's constructive.
But they're clearly holding back. They're looking ahead. It's all about future execution now, particularly on those high margin deals. It's definitely a guarded reaction.
Okay, so let's unpack that 56% growth. The year-over-year jump was about $2.7 million in revenue. Where did that come from? Was it all Kyber?
Overwhelmingly, yes. The Kyber Data Science deal accounted for roughly $1.9 million of that $2.7 million increase.
So about two-thirds of the jump.
Pretty much. The rest, the other $800K or so, that was organic growth. New pharma projects, some renewals in their existing life sciences business.
So Kyber is definitely the main engine right now. Confirms the M&A thesis.
It does, for the immediate term anyway.
Now, management talked a lot about their core asset, the Chronos Data Lake and this data factory idea. Why is this more than just, a big database? What's the strategic moat here?
Think of it like this. Raw patient data claims, electronic health records, lab results, it's messy. It's like crude oil.
Okay.
Chronos is the lake where they store it all, but the data factory, that's their proprietary refinery. That's where the magic happens.
Refining the crude data.
Exactly. They focus intensely on normalization, cleaning it all up, standardizing all those complex medical codes, ICD-10 for diagnoses, CPT for procedures, NDC for drugs.
Which is crucial, I imagine. Makes everything talk the same language.
It's absolutely critical. It means data from Clinic A can actually be matched and analyzed alongside data from Hospital B, even if they use slightly different systems. They de-identify everything for privacy, of course, but, and this is key, they keep linkage keys.
So you can follow one patient's journey across different touch points over time.
Precisely. Longitudinally. That's the foundation for generating reliable real-world evidence, the RWE we mentioned.
Right, because pharma needs that RWE to show how their drugs actually work out in the real world, not just in a perfect clinical trial setting. And if the data is messy,
that RWE is questionable, maybe even useless. Pharma companies won't pay top dollar for unreliable data. That cleanliness, that linkage, that is the moat. It's the process, not just the volume.
Got it. Okay, let's shift back to the financials for a sec. Stability, they talked about the margin improvement coming from Kyber, but also just tighter operations.
Yeah, cost optimizations played a role. And they've really shored up the balance sheet. Remember, they cleaned up a bunch of debt in 2024.
The convertible notes, right. Retired about $17 million.
That's the one. So heading out of Q2 this year, they ended with $35.6 million in cash and marketable securities. Solid position.
And the remaining converts? Weren't they due soon?
Due next month, actually, September 2025. but it's only $6.8 million left. Compared to the cash on hand, it's very manageable.
So they've basically handled their biggest near-term financial risk, sitting on a nice pile of cash now.
Gives them a lot of flexibility, a lot of optionality looking forward.
Speaking of looking forward, that strong Q2 didn't actually lead to them raising their guidance for the full year. They just reaffirmed it.
Yeah, they stuck to the existing range, which, sets up a pretty crucial second half.
The reaffirmed range is $28 to $30 million in revenue. Still impressive growth, 39% to 49% year over year.
Huge growth, yeah.
But the adjusted EBITDA range is wide. Negative $1 million to positive $1 million.
Right.
What's the biggest single factor that determines whether they hit the top or bottom of that revenue range?
It really comes down to the Kyber annual license renewals. Those are heavily weighted towards the back half of this year.
Annual renewals, not multi-year deals.
Some of Kyber's business is structured that way, yeah.
Yeah.
It means there's more execution risk each year compared to, say, a 3-year contract. Management sounded confident on the call, but
the environment is still iffy, right? Pharma spending is mixed.
Exactly. Everyone's cautious. So those renewals absolutely have to come through for Forian to hit that high end of the $28-30 million range. The market knows this. That's part of the show me story.
Makes sense. Annual renewals are where budget caution bites first.
Definitely. And that EBITDA range, the -1 to +1 million, that's largely about discretionary spending.
How so?
Well, management said point blank they plan to keep investing. Buying new data assets, improving the product portfolio, if they decide to pull the trigger on some significant investments in Q3 or Q4.
The costs hit the P&L immediately, potentially pushing EBITDA down towards that negative $1 million mark, even if revenue lands strongly.
Right. They're signaling a willingness to invest for the long term, even if it impacts near-term profitability slightly, prioritizing growth and capability building.
Looking beyond just this year, then, if Kyber is the short-term rocket fuel, what are they betting on for longer-term organic growth?
They specifically called out HER studies, that's health economics and outcomes research.
Okay.
They said they're seeing high win rates there, strong demand. It's shaping up as a key growth driver heading into 2026. That ties right back to Chronos and the data factory.
Because those studies demand super clean, reliable, linked data.
You got it. It all connects.
Let's pull back again, the broader sector context. Why the muted reaction overall, even with these operational wins?
The backdrop is genuinely mixed, as they put it. Pharma needs the RWE, no doubt. That underlying demand is real. But macro uncertainty is making them cautious with budgets. They're spending, but scrutinizing every penny.
And you can see that caution reflected more broadly, right? Like in the sector ETFs.
Yeah, look at the IHI, the iShares U.S. Medical Devices ETF.
Yeah.
It has lagged the S&P 500 badly this past year. S&P's up, what, 17%?
Something like that.
Forian's barely positive, maybe 1.9%. The whole space is viewed with some skepticism right now.
So for Forian specifically, investors are watching for what? Near-term signals?
3 main things, I think. 1, successful Kyber renewals, that's a big one. 2, news of new HER projects closing. 3, any hint of tuck-in M&A.
Okay, M&A. With that $35 million in cash, what did they signal there?
They basically said they're actively looking, but selectively. And here's the interesting part. They mentioned that private market valuations are resetting, meaning those high-flying venture-backed data and AI companies. Their valuations might be coming back down to earth after the pandemic boom. This could create chances to buy assets that boost their pharma reach or tech capabilities more affordably.
That cash pile suddenly looks even more strategic then.
It really does.
Which leads us nicely into
our final segment. This is the deep dives. This is not financial advice segment. We take the context, the strategy, the numbers, and cook up an outrageous but plausible trade idea.
Okay, let's set the stage. You've got Forian with $35.6 million in cash, essentially secured once that last bit of debt is paid next month.
Shit.
Management explicitly states they're looking for M&A targets that strengthen their pharma position.
Right.
And they specifically note that valuations for some potential targets, especially maybe AI-focused ones, are becoming more attractive.
Right. So the setup is clear. Here's the pitch. Go long Forian.
Okay.
The bet is that they announce a significant, strategically smart tuck-in acquisition late in Q3 or maybe early Q4 this year.
Using that cash pile. Exactly. The core idea is they use that cash so it's non-dilutive, no new shares issued, to grab a smaller, maybe slightly distressed, but highly valuable data or AI company. something whose valuation has corrected sharply.
And the strategic fit would be
Something that immediately juices their HEOR pipeline, or even better, integrates next-gen AI analytics directly into the core Chronos RWE platform. They have some AI through Kyber, but this would be a major step up.
so leveraging the cash for non-dilutive growth, specifically targeting AI, to accelerate the shift towards that durable, subscription-based RWE model.
Precisely. Remember that muted market reaction? Investors gave them credit for the cleanup, but just a little. An accretive, non-dilutive deal like this, especially one boosting their AI story, that could fundamentally reset expectations.
It flips the narrative from show me execution to show me growth acceleration. Could definitely lead to a re-rating well beyond that little 1.6% bump.
It's a bet on management's timing and their ability to deploy that capital smartly and opportunistically.
A high-stakes move, but plausible given everything they said.
Okay, let's wrap this up. To recap, Forian delivered a really strong Q2. Top-line beat, operational leverage showed up, Kyber integration looks successful so far, and the balance sheet is clean.
Yep, the foundation looks solid now, but the market's message is clear. The next 6 months are critical. It all hinges on execution, particularly nailing those high-margin Kyber renewals. That performance has to match the confidence management projected on the call.
That's the key question. And as you look further out, think about the potential impact if they successfully weave more advanced AI-driven insights across that whole RWE platform. That's where the real long-term value could be unlocked, turning the data refinery into a genuine predictions engine.
Something to watch for sure. Thanks for tuning into the deep dive.
We'll catch you on the next one.